So when you look at the financial statements, the idea is essentially to first understand the relative requirement or need of all the statements. We have 2 or 3 statements that are available with us, and it sometimes kind of intrigues us as to why do we need all those and what's the relevance of all those. So it's important to kind of comprehend the need and relevance of each one of them. What kind of data do all of them show us, and why are they important in the context of an overall financial analysis? It's also kind of interesting to understand how do they link with each other or talk to each other, and how does a decision in the business change one statement or the other, or multiple statements at the same point of time. So that's what we're going to do today. In the agenda in this particular session, we're going to kind of cover a little bit of understanding of the statements, cases where one statement kind of does not show a complete picture, and so you need more than one statement to understand it. How does the linkage of these work, and probably also a small exercise that will deal with the discussion around linkages of financial statements. So the first concept that we need to understand is that there are 3 broad financial statements which are available. There's a profit and loss statement or the income statement, which tells you about the company's business, what the company earns through its business, and the company's expenses. What kind of costs does it incur while taking those businesses as you look at conducting that business. If you look at another set of statement that is available, that's something called as the cash flow statement, and that looks at what kind of funds have flown into the company and what kind of flows have gone out of the company, right? So that basically kind of explains how do you look at the money coming in or money going out of the company. This cash flow statement you could kind of envisage this as your bank account statement, right? If you look at your bank account statement, you'll see money coming in, money going out. That's basically the construct of a cash flow statement. And then there is a statement called the balance sheet, which is nothing but a statement of liabilities and assets. What do you owe to someone versus what do you own, right? So any business will own assets, and it'll owe someone the money that it has taken to kind of buy those assets. That's called the liabilities portion. So that's the context of the 3 financial statements that are there, and how do they link with each other is what we're going to follow and understand now. When you look at the financial statements, typically the financial statements are constructed like this. So the balance sheet is typically as on a given point of time. What do we mean by as on a given point of time? Your business will owe money to someone, and it will own a certain set of assets at any given point of time. This could change the very next minute, the very next hour, because you might have returned money to someone, you might have raised more money. So the balance sheet is at a point of time. It's at a point of time, right? And then you have another point of time, which is, let's say, March 31st, 2019. You'll have the balance sheet there as well. In going from this point A to point B, the company would undertake some business transactions. What do we mean by business transactions? How does the company make money? So if it sells marker pens, or if it sells water bottles, then that's your business transaction. And buying raw material for that is your business transaction. So is it doing those business transactions profitably is captured in the P&L statement, and what kind of cash has flown into the company or out of the company is captured in the cash transactions in the cash flow statement. So very simply put, your balance sheet is like a snap. It's also known as a snapshot of the business. Your P&L account is like a video. It's a flow statement. It's periodic. It's between point A and point B, which also means that the P&L only talks about that period. The balance sheet is an additive or cumulative number. So it keeps adding to the previous year balance sheet. So A plus this set of transactions is going to give you B. And then you'll have a set of transaction and you'll reach point C. So that's how the balance sheet works. So balance sheet is additive. It is cumulative in nature. So it does have traces of previous statements of the company. If a company did an acquisition in 2005, it will appear in 2010, right? Unless they've written it off, of course. The P&L and cash flow, however, are periodic statements, and they only talk about that particular period, whether a quarter or a year, whatever that is, it only talks about that particular period. It doesn't go beyond that, right? Now, what is the relevance of each of these? How do they kind of interplay? How do they come around and work? Let's quickly look at sample financials first. So what you see on the screen is the balance sheet and P&L of Reliance Industries, the latest ones as they appear from their annual report. So as on March 31st, you will see the balance sheet will be divided into parts such as assets, which is what you own, and liabilities, which is what you owe, right? Now, when you own something, that could be non-current, which is basically long-term in nature, usually greater than 1 year of useful life of that asset. And then there are current assets, which are short-term in nature, and usually this is less than 1 year in life, right? These are simplistic definitions I'm using, but broadly that's what you would see as long-term assets or short-term assets. These are essentially business generating assets. So they'll give you money if you use them, right? That's what a company does. Now, how does a company buy these assets? From where does the company get the money to buy these assets? That's what you owe to other people. And that's what is called as liabilities. Now, liabilities could come in two forms. It could either come in the form of equity, which is basically your shareholders putting in some money, or it could come in form of other external liabilities, which could largely be debt and others. So you could borrow money or you could put your own money. And basically that's what would kind of construct the entire idea of a company's liability, right? So that's basically the construct of where you are getting the money from. So for a liability, you could either get the money from equity or you could get the money from debt. This is money that you're supposed to return, right? So even if you've raised equity from the promoter of the company, technically the promoter and the company are two different entities. The company is supposed to return this money back to the promoter at some point of time. Again, within liabilities, you will see the longer term liabilities and you'll see the shorter term liabilities. Once again, the broad definition is greater than 1 year and less than 1 year. So if I take a loan for 5 years, that's a long-term financial liability or borrowing. If I take a loan for 6 months, that's a short-term financial liability or borrowing, right? So that's how they classify these statements. Just think of it very simply as a company that is starting the business is going to raise some money. That money is going to come from the liabilities, guys. The liabilities, therefore, are also known as sources of funds, because these are the guys who are giving you money, right? The assets are also known as application of those funds. And consequently, when you start a business and let's say you take money from me, that's going to be a source of money, or so that's a source of money for you. You're going to use that to create a business. That's an application of money. Both these statements always have to match. If you look at the money that comes to you, and you'll either use it to buy something or you'll keep it in your pocket, right? So when a company raises money, it can either use it in terms of buying a business generating asset or keep it in the form of cash and cash equivalents. Beyond this, everything that you do, it is going to get added in terms of either doing a transaction on both sides of the balance sheet or on rearranging items on one side of the balance sheet. So at this point, there are a few things that we should probably take. There's a column called notes. So in the annual report, there is an explanation or detail of all these data points. So you could look at these notes and understand this. Not very important at this point of time for us. The context of a company's equity being a liability is an important one. Remember, the company and its shareholders are different entities. The shareholders are giving money to the company to run the business. The company is supposed to give it back. And because the company owes this to the shareholders, equity is a liability. Does that make sense? I mean, technically, if you are starting a business, now the thing that kind of muddles this is obviously it becomes a little bit confusing, is because usually you are the one who's starting the business and you're putting your own money and the company is also yours. But remember, the company is a different legal entity. The company gets the money from you. You are the owner of the company. The company will run regardless of whether you are there or not there. It is supposed to return this money to you at either periodic intervals or when the business closes down. This money of the equity holders is supposed to be returned back to them in the longer context of things. right? So that's how you would treat equity as a liability as well, right? Then you move on to something called as the P&L statement, which is basically how have you made money there. And so you have an income here and you have expenses here, right? What is your sales? Either a product or a service. What is those values that you're getting from? And then you have the expenses, which could include things like raw material costs, which could include salaries, which could include interest, depreciation, some of the other things, taxation, etc. Finally, you come to the profits. So you have your sales, you have your costs, and you get to the PAT. The topmost line in this is called sales. That's called the top line. You must have read this term somewhere. The bottom line here is the profit, and that's called the bottom line. So a company's bottom line is its profit and top line is its sales as you look at it, right? So that's the broader contour of what data points are there. Very quickly, just a quick understanding of some of the other data points that are there while we are at it and we're looking at it. If you look at assets, you would see terms like tangible assets and intangible assets. So intangible assets is something like patents, license, copyrights, etc. So a telecom company might be bidding for a license. It's not you can't see the license, right? Or a radio city or a radio Mirchi would be bidding for a radio license, and that bid amount that they've paid is like a building for them, and that's an intangible asset that is going to be there, right? So that's the construct of tangible and intangible assets. That's the construct of the data points that you have. And you kind of find these statements for all companies. You would kind of look at these statements for all companies, and then we kind of go ahead and try and understand the concept of how a business works. So let's understand how do these statements interact with each other, right? So let's take the balance sheet, for example, and let's say we start a business. When we start a business, we could be borrowing money from someone. We have to borrow money from somewhere. So let's say we take a share capital from somewhere. And let's say we take a share capital of argument's sake 1 lakh rupees, right? How do you typically get share capital? You issue shares. So shares are issued as 10,000 into 10 rupees each. That gives you a share capital of 1 lakh rupees. Now this could be anyone. For example, let's say you are starting the company. I have given this money to you. So I am a shareholder here. These 10,000 shares have been given to me. I have given you 1 lakh rupees. You start the business with 1 lakh rupees. The money will obviously arrive in the company's cash and bank balances. So I'm going to write this as cash and bank. And wherever I use the term cash in this, that's like equivalent to bank. And so it'll appear in the bank balance at this point of time. And that's how the balance sheet balances, right? Correct? Now the business starts, and this is right at point 0. Now you can start running the business. As you start running the business, remember that the share capital is still 100,000 or 1 lakh. The cash could be used to buy fixed assets. So maybe you bought 1 lakh rupees of fixed assets and cash is 0, right? This transaction of the company buying fixed assets has rearranged the items on the asset side of the balance sheet, taking cash and putting it into fixed assets. So the money goes there, but it stays balanced. At the end of this transaction, you'll again see that the numbers are the same. The summation of the liabilities and the summation of all the assets is going to be the same. Now let's assume the company starts doing some business. Once the company starts doing some business, let's assume the company generates a post-tax profit of 20,000 rupees. Right? That's a 20,000 rupee profit generated. If you generate a post-tax profit of 20,000 rupees, the number should appear like this is still 1 lakh. This is, let's say, 100,000, and assume for a minute that my assets remain in the same shape and size as they are. So I've kind of taken care of any kind of wear and tear that might have happened. So it's still at 1 lakh. But because I made 20,000 of net profit, I am sitting with a cash of 20,000 at this point of time, right? Now, there are two things that can happen here. Whose money is this? This entire money that started the business and the profitability that came out of it belongs to the shareholders. So the company could either pay the shareholders what is called as a dividend of 20,000. If you pay a dividend of 20,000, this 20,000 will go away. It will become zero here, right? So this will become zero here, and you'll be left with fixed assets of 1 lakh and share capital of 1 lakh. So that's how it works. If you pay a dividend, you could choose to reinvest the money. So what happens in this case is you made the profit of 20,000. Now, usually there is a shareholder meeting where the company says, do you want us to give you a dividend? Right? You're asking me in this particular case that would you want a dividend? And I tell you that, look, this is from the shareholder's idea. I would want to basically reinvest this money. So you can keep this cash with you and you can generate more income with this, right? So maybe you take the cash and buy more fixed assets with this. Right now, how does the balance sheet balance? Because think about it, that this is my money. This is not the company's money. This is supposed to be returned to the shareholder. The shareholder has just said that, you can keep the money for the time being. So what happens, because you are reinvesting the money, you take a concept called retaining the money, or you take a concept called retained earnings, right? That retained earnings gets associated here or introduced in the line items here. So you have, let's say, cash of 20,000 and fixed assets of 1 lakh. Now this 20,000 belongs to the shareholder but is retained in the company. So that'll appear here, which basically means retained earnings is also known as reserves and surplus in the balance sheet parlance, which basically means that now your total liability towards the shareholders is 1,20,000. You could also think of it this way. If you were to close this business today and sell all these assets, you're going to make 1,20,000, which is to be paid to the shareholders, right? The other interesting thing that happens is that the number of shares is still 10,000. That hasn't changed. But 10,000, the value of those should now be 1,20,000. So logically, per share value, the minimum value should be 12 at this point of time, because that's what you can derive right away by buying this company here. So in a sense, that's how your share price starts moving. Remember, in a real stock market, there are many other elements to this, but to understand it simplistically, if you make a profit and that profit sits here, it is retained into the company, then either the shareholder will benefit in the form of a dividend being paid of 20,000. So that's 20% on the money, or the share price should reflect this growth. So you still make 20% on your money. The share price should reflect that 20% return. Correct? Now that's at the end of the first year. What if you continue your business at the end of the second year, right? So let's say in the second year, you first of all use this and it goes here. So let's rewrite this a little bit. We are saying that share capital is 100,000, retained earning is 20,000. Now that doesn't mean these retained earnings or reserves are free cash. It's quite possible that cash becomes zero and fixed assets have now become 1,20,000. It is not distributable or free cash available at this point of time. The cash is now used in the business. Second year, the company makes a cash profit at the end of taxes of, let's say, 40,000. Right? So what will happen? Your cash account will start showing 40,000 at the end of year 2. Once again, you have a choice. Let's say now the company shareholders say, give us a dividend of 10,000 rupees and retain the remaining. What is the remaining part out of 40,000? 30,000. So how will the statements appear? Your share capital will be 100,000. Your reserves and surplus, however, would not be this. Your reserves and surplus would change and your cash will also change. So how do they change? Your reserves and surplus is going to change to 20,000 of last year and 30,000 of this year. Remember, 10,000 is already paid out. So the cash is only 30,000 now. So reserves and surplus is 50,000 now. What does this reflect? It tells you that if the company closes now, there is a profit of 2 years that needs to be distributed. So retained earnings tells you that this is a cumulative header. You're keeping adding on the numbers to the previous year numbers, and that's how the balance sheet would move, right? Any transaction that the company does, either both sides of the balance sheet are going to get affected or one side items are going to get rearranged. If a company borrows money, let's say if this company now borrows 50,000 rupees, that 50,000 will go and sit in the cash as well. The first thing if you borrow money is that money is going to come to your bank account, right? So that's how this retained earnings concept plays out. That's how the balance sheet moves, and that's how the P&L links to this entire thing, right? So broadly, when you make a profit or a loss, this goes and sits on the liability side of the balance sheet in the form of a header called reserves and surplus. At the same time, if there is a cash that has been generated here, then this will go and sit in the form of cash and bank balances on the asset side of the balance sheet. So that's how the item kind of balances itself on both sides of the balance sheet when you're looking at doing this. We'll do an exercise on this, and that will make things clearer as you go along this. But this is a very simple exercise to understand how does a P&L and a balance sheet kind of link with each other. Let's introduce the third statement, which is the cash flow statement. Now, what is the purpose of the cash flow statement? Is that it's quite possible that I, let's say, sell tables at a particular price, and I generate a revenue of, let's say, 10 crore out of selling tables, right? But I only collect rupees 5 crores. So I tell you as a seller of a table that you can buy the table today but pay after 6 months. You don't need to pay right now, right? So in my P&L account, I will record 10 crore as sales, but that will not reflect whether I have received the money or not. P&L does not talk about that. It only talks about the business transaction. The cash flow is going to tell me whether I have received the money or not, right? And when you construct the cash flow, there's a method of constructing the cash flow known as the indirect method of cash flow construction, right? You'll probably read about it as you go along, but let's kind of understand how do you build a cash flow. To understand cash flow, we will introduce 3 or 4 line items. A receivable is a sales amount that is outstanding. So in our last example, 5 crore was collected, but 5 crore was outstanding. That's a receivable. The company is supposed to receive it. Similarly, if I have to pay something to my supplier, that's a payable, right? Now let's try and understand the cash flow of this particular company. The company makes a sales of 1000 crore and has a cost of 600 crore. So you have a net profit of 400 crore. So I'm making a very simple cash flow statement. Let's assume you start with the net profit of 400 crore. What is the assumption here? All sales recovered, right? And all costs paid. That's where you start the assumption with, correct? Now you realize that one of the costs in your P&L statement is a non-cash cost. We don't have it here, but there's a cost called depreciation. That's not an actual cost. That's an accounting treatment. You're just writing off an asset over its useful life, so you add the depreciation. Let's assume the depreciation is a number, and we can ignore that here. But then there are a few interesting line items that happen here. So look at the receivables line. Last year, receivables is coming from the balance sheet, remember. Last year, receivables was 0. This year it is 100. That means it has gone up by 100. What is the receivable? It is money that you have not received. What was the sales? 1000 crore, which basically means if receivables have increased by 100 crore and sales is 1000 crore, sales recovered must have been 900 crore. Correct? You have not received the entire 100, 1000. You've only received 900. That's why receivable has gone up, right? Now, the net profit, if you start building the cash flow with the net profit, you're assuming that all the 1000 was recovered. Because that has not happened, you're going to subtract a change in receivables. Right? And what is the change? That's 100. Your actual cash flow is only 300 at this point of time. It's not 400 because you only received 900. You have not received the entire thing. Interestingly, payables have also gone up. So last year the number was 50. This year it has become 100, which means you have not paid 50. Right? I can write it here, not received 100 and not paid 50. If you have not paid 50, it should be in your pocket. So you add that. Change in payables, that's an added number, that's 50, right? You adjust this, and in fact what you do is you subtract any change in current assets. Receivable is a current asset, and you add any change in current liability. Payable is a kind of current liability. So that's the generalization that we are doing here. Then you subtract any capital expenditure. If I buy a truck for the business, that's a capital expenditure. That's given here. How much is that? 200. So that's subtracted. And then I might have funded it using a debt. So change in my borrowings or debt is going to be added. So if you were to build the cash flow for the year, that's 400 minus 100, that's 300, plus 50, that's 350, minus 200, that's 150, and plus 100, that's 250. That's how you build a cash flow. So any increase in current assets is basically going to result in money getting stuck in the business. You have not received that cash. So if you're starting from the net profit, you're going to subtract it, right? That's typically how these numbers work in your financial statements, and that's how you would try and build a cash flow statement as you look at it, right? Now let's go one step further and introduce a couple of other things. Let's first try and understand a little bit about a few cases which highlight the importance of multiple statements, right? So what you see on the screen is the consolidated P&L statement and balance sheet, excerpts of this for a particular company for the years March 2008, 9 and 10, right? These numbers are in INR crore. These are actual numbers of a company. So you're looking at this statement now, P&L statement, and you look at a particular year. And if I were to ask you to think about which year do you think is the best year in this set of statements, what would you think would be the answer? If you look at these numbers carefully, you'll probably believe that the sales are the highest in 2008 and the profit is the highest in 2008. The company was selling something around 14,000 crore and making a profit of 7,800 crore on that. And the sales were lowest here and profit was lowest here in these 3 years. So it appears that 2008 is the best year. If you dig a little bit further in terms of these numbers, there is one number that you find here. Now, what do you call as sundry debtors? This is receivable. So money that you have not received. Look at the number for the other 2 years versus this particular year. So in this particular year, you have 7,600 crore of receivable on a sales of 14,000 crore, which basically means you made a sales of 14,000 crore, but did not receive 7,600 crore. That's, more than half of the sales is outstanding. Now, you will probably receive it at some point of time, but what it seems is that generally out of what sales you do, 10,000 crore, 20% is outstanding. 7,500 odd crore, 20% is outstanding. But in this particular year, 50% is outstanding. If you look at only the P&L, you will miss this picture that most likely what has happened is that the company has tried to sell aggressively. And how can you sell aggressively? Is you can go and tell your client, don't pay. You can pay later on. Is that a problem? Of course that is a problem, because at some point of time, you might have a scenario where the client refuses to pay. There is a collection cost associated with it. How do you fund your business if you don't receive the money? There's a cost associated with running the business on a day-to-day basis, right? So if you do not kind of collect this data point, this sales, that's going to be a challenge. And you will not find this information in the P&L. To get this information, you have to either look at the balance sheet or look at this cash flow statement where you will see an increase in receivables. An increase in receivables will tell you that, look, this company has not received a lot of the money that it has sold for in the last year. And that's the relative importance of the other two statements. Take another case. If you look at this particular company, in the case 2, look at the data points for 2010, 11, 12. Sales are increasing marginally, But operating profit goes up, and operating profit margin, which is nothing but operating profit divided by sales, that number has gone up from 0.76% to about close to 5%. Right? So there's a benefit in terms of higher profitability. The company seems to be more profitable, correct? And it seems to be generating twice the amount of net profit as well. Leave the other items aside. It seems to be more profitable over these years, but that is only true till the time you don't put in the cash flow statement. Now, typically cash flow statement is divided into multiple segments. And if I go back a little bit here, this entire part that you see here, and let's probably look at this in this way. This entire part that you see here is cash flow from your operations. This part here is cash flow from your investing activity because you're buying an asset or so. This part here is financing activity, right? So there are three different components to the cash flow that you see there. And if you add those three components here, you see that cash from operating activity is consistently negative. Now, a company cannot run the business if it is negative. It has to get that money from somewhere. So they seem to be borrowing money, 700 crore borrowed, 500 crore cash loss from operating activities. And think about it. How did you reach from net profit to cash from operating activities? Net profit plus depreciation. So there is an addition. The number should become higher. And then you subtract a change in current assets. It looks like receivables should have increased once again. Correct? If receivables have increased, you have not received that money, and that is the number that is going to get subtracted. That's why the number can become negative. Otherwise, how did you reach from 100 to minus 508? And that keeps getting worse and worse. In fact, in the last year, if you see this carefully and you were to decode this, they actually had a negative number in financing activity as well. This should be an outflow, which basically means if they were borrowing from a bank, the bank refused them money. You still are losing money. So what do? You end up selling assets. That's why you see this positive number here. That's because you have sold assets. Now, how do you look at that? Again, if you look at just the P&L, it'll look like great, or at least a good picture of an improving company with a higher profitability coming in at some point of time. Only when you start looking at the cash flow statement is when the picture becomes clearer, and it tells you that, look, it might be selling, but it is not collecting. Now, the first company that you saw here was DLF. The second company that you saw here was Power Trading Corporation. This is live data, not a hypothetical data set. This is a scenario where a company seems to be doing well in terms of sales and in terms of profits, but it does not collect money. It has not received its money, and that is causing a big problem in terms of the cash flows of the company. Remember, a company can be profitable yet may not have cash with it. If it has not collected money from its buyers or customers, the company could still go bankrupt without the cash, even though it is selling something profitably. I can produce a table for 50 rupees and sell it at 100 rupees. But if I do not collect that 100 rupees, I am net down by 50 rupees in that entire picture. And if I'm hoping that I'm going to collect it at a later point of time, that's probably going to be a problem for me in other senses, right? So that's where this construct comes in. That's how basically these statements link with each other. That is what is the relative importance of these statements. And it's important to understand that you at least try and look at all these statements and not just focus on only the P&L statement, which is available very easily and honestly is the easiest one to cook as well in real life, right? With that, we'll just do a quick recap of this entire thing. So the balance sheet is on a particular day, and from going from point A to point B, the balance sheet tells you what does the business owe and what does the business own. The P&L talks about business transaction, which is basically asking the question, how profitable is the business? And the cash flow statements tells you about the cash position, or in other words, the liquidity position of the company. these three statements tend to interact with each other. And that's basically where the construct of these statements are going to come in terms of your overall understanding. Each of them throw light on a different piece of the puzzle. Think of it this way. If you were to look at the architecture of a building, you need three views. You need the front view, you need the side view, and you need the top view. Unless you have all these three views, you can't really create a projection of that building in your head clearly, right? To understand a financial position of a company, you need these three statements. You have the balance sheet, you have the P&L, you have the cash flow. The balance sheet tells you that at any given point of time, if the company were to wind its business, what is it that its shareholders are going to get? Does it have enough assets to repay for its liabilities or not? The P&L tells you how profitable it was last year. And the cash flow tells you whether that profitability actually resulted in money flowing into the company or not. Did the company give more money outside? Right? So all kinds of things can be ascertained from the cash flow. And remember, cash flow leaves a trail. So it's the most difficult statement to fudge when you look at it, right? So that's the crux of this. Let's now do a small exercise. In this exercise, we're going to use an Excel file and look at a few business decisions. And as those business decisions get taken, how does that impact the three financial statements of the company is what we are going to look at. So what you see is an Excel file where a company's income statement is available, and it's all blank at this point of time for year one. The company's cash flow statement is available. That's for year one. Again, blank at this point of time. The formulas are probably fed in, but that's there. The balance sheet is available before year one and after year one. So obviously it's at a point of time. So the company starts with equity of 500 crore, and that's in cash. That's at the beginning of the business. If it does nothing during the entire year, then that's how the statements will look, and it'll end the year with 500 and 500. No change. Correct? Now we realize that that's not the case. The company is doing some business, and there are some business transactions. So let's look at each one of these business transactions and see how it changes things. So we started with the scenario of 500 and 500. Take a look at the changes that happen. We're only going to put in numbers in the balance sheet and the P&L. The cash flow will get constructed automatically. These formulae are already there. It's going to get constructed automatically. The purpose is to understand how the statements move. So the company raises 200 crore as long-term loans. So the first thing that happens as the company raises 200 crore as long-term loans is you add that in long-term loans, and that's 200. So obviously the total liability now becomes 700. Because you have added long-term loans of 200 crore, cash flow from financing is going to show a 200 crore positive number. Net cash flow for the year is 200 crore. You began the year with 500 crore of cash flow, which was last year cash. You end the year with 700. This 700 goes and sits here, right? At the end of this, the total assets and total liabilities, we can subtract each other, and that's a check item that's available. That should be 0, right? Now there's an interest rate of 10%, which basically means there's an interest cost that is going to come here, and the P&L. So finance cost of 20, profit before tax of 20. Because you're making a loss, there is no tax. Net profit minus 20. Obviously cash goes down by 20 because your cash flow now incorporates a minus 20 number for net profit, but it does not balance on the other side of the balance sheet. Why? Whose money is lost? You still have to repay the 200 crore to the bank. The money lost is for the shareholder. So this minus 20 has to come and fit in there, and that's the money lost for the shareholder. If the company was to close right now, the shareholders are only going to get 500 minus 20. That's 480, right? Next business. Next step in the business, the company buys plant and machinery worth 400 crore to begin operations. So the moment you buy plant and machinery worth 400 crore, you see this term called gross block. This is also long-term assets or tangible assets. You add 400 crore there. What happens, you see, is the cash goes down. So if you look at this transaction, cash is at 680, and now when you add 400, cash becomes 280. Rearrangement of items on one side, right? Now there's a depreciation of 10%. So depreciation means the asset loses 10% of its value. So you write off 40 there. Total loss becomes 60. Reserves and surplus become minus 60. Total liabilities are of course 640 now because shareholders have already lost 60 in the value. Net profit is minus 60. You also add the depreciation. Remember, the cash does not change because of this. But what does not happen here is that the asset has lost its value. So the asset has lost 40 of its value, and the depreciation now is 40. So the net value of the asset is 360. Now you see total assets is 640 because you have 280 in cash and 360 in the end year value of the asset, and total liabilities are also 640. Who has taken this 60 crore of hit? The shareholders. Next step, the company invests 100 crore in mutual funds. That's an investment. The moment you do an investment, you'll put 100 crore here, and when you put 100 crore there, the cash will go down by 100 crore. So the balance sheet items rearrange themselves, correct? You go further, the company buys raw materials worth 100 crore. When they buy raw material worth 100 crore, inventory adds up. So inventory adds up to 100, cash goes down to 80. No change in the overall balance sheet size, that remains 640. The balance sheet, if you see right at the bottom of the screen, is still balanced, correct? So inventory goes up to 100. So far, the company has not done any business. Now the company starts doing the business. After converting, step 5, after converting the raw materials into finished goods, the company is able to sell it for 300 crore. So multiple transactions happen here. One, the company has sold this 100 crore of inventory. So inventory goes to 0, right? Cost of goods sold is 100. And how much do you make on it? 300. Now look at it carefully. You add up 300 crore of revenue, right? And you take a cost of 100 crore. That gives you a profit of 200 crore. So let's repeat these two transactions again. What has happened is that the inventory has gotten sold. So let's divide into two steps. The first step is, let's assume the 100 crore inventory got sold for 100 crore. So inventory gets written off and you have received your 100 crore back. If you were to sell it at the same price point, you have received your 100 crore back. So that's the crux of the matter at this point. You do realize that the company, however, sold it at a profit. So the revenue was 300. So what do we think? If an extra 200 comes here in the revenue, would you see an extra 200 in the cash as well? Ideally you should, but remember that the moment you see a 200 extra coming in the revenue, you will have a profit, and that profit would result in a tax. That tax would be the amount that would go off in terms of the business. So let's put this 300 here and let's look at the changes. Note the cash figure here, 180 at this point of time. Balance sheet size, 640 at this point of time. Enter. Now look at this. So we introduce a gross profit of 200. That gives us a final profit before tax of 140. Why? Because 60 of loss was already taken. On 140, there is a 30% tax of 42. So this extra 200 that came in, you reduced that by tax of 42. The 158 number gets added here. 180 changes to 338. You noted 180 was the cash number before this. It goes to 338. Balance sheet size, which was 640, has added 158 again. So that's become 798. And now the shareholders are making money. They're making money because there's a profit of 98. 140 minus 42. That's the profit that is there. And thereby the company has now started making money. Now you note that step 6, in this entire process of making this product and selling it, operating costs are 50 crore. So you would have an operating expense of 50 crore. 50 crore of operating expense would reduce your profits by 50 crore and profit before tax by 50 crore. It will also reduce your tax, remember. So 30% of 50 crore is the saving that you will have. You do this, tax, note that tax goes down to 27 from 42. And while your total expense increased by 50 crore, cash went down by only 35 crore. Profit went down by only 35 crore is because tax also went down. As your expenses increased, your profit before tax decreased. As that decreased, your tax decreased. So the net impact was minus 50 plus 15. And so that 35 gets adjusted here in the cash flow, right? So that's the crux of the next step. Now let's see what happens. Some clients do not pay upfront. So you have done a sales of 300, but 100 crore worth of client payment has not come in. What is this? This is receivables. Now, if 100 crore has not come in, what is going to be the impact on the cash flow? That's going to be negative. So if I add a receivable of 100 crore here, note that balance sheet size will not change, but the cash number, which is appearing 303 right now, will become 203. Then you note that the company also delays payment of 50 crore to one of its supplier by 1 year, which means some of this cost of goods sold has not been paid. That's a payable. That's a current liability. So current liability goes up by 50. Note this will increase the cash on the other side of the balance sheet. The balance sheet size actually changes to 813 now, right? Then just before the year ends, the company chooses to sell investments worth 50 crore. And the market value of these is 60 crore. So what is the profit the company has made? 10 crore. So first thing, investment becomes 50 and cash becomes 303. This is assuming no profit. Now assume there is a profit of 10 crore. This is non-operational profit. So it will get classified here in the other income cell, and you'll pay tax on other income as well. So I'm going to put 10 here. There's a tax on other income. Tax of 3 crore will come in there. And so cash goes up to 310. Balance sheet size at 820. Liability 820. Asset 820. Balance sheet balances. Final step in the business, the company chooses to pay a dividend of 10 crore. If you pay a dividend of 10 crore, that's a cash outflow. Before the dividend, you had a cash of 310. After the dividend, you have a cash of 300. If you have a cash of 300, it does not balance the balance sheet. That's because if you have paid the dividend, the shareholder claim needs to go down by that amount. You've already paid that money, right? So why should the shareholder get that 10 now? The shareholder claim is only 60 now because you already paid 10. So reserves and surplus is the retained portion of the profit, not the dividend. So if you've paid the dividend, that's gone. The retained portion is 60, which is here, balance sheet balances, and that's where the exercise basically gets closed. So if you look at this exercise broadly and try and make a sense of the broader learning, any transaction will either change the balance sheet on both sides or rearrange items on one side. But after every transaction, the balance sheet should remain balanced. If after any transaction that the company does, the balance sheet is not balanced, we have made a mistake somewhere. That can't be true. It has to stay balanced, right? So that's broadly the contour of this exercise in terms of what gives you a sense of how do these numbers link with each other as you look at. In a nutshell, obviously there's much more that you can cover on the balance sheet, P&L, cash flow statements, look at individual headers and items. But there are a few things that you need to be very, very certain about. One of those things is that a lot of what you read in accounting, which is journal entry, ledger, trial balance, etc., is not really needed. We just made a set of transactions on a company and we didn't need all that, right? So it's great to know that. But even if you don't know that, honestly, that does not stop anything. It will not stop your learning on the context of understanding financial statements of a company. I have never used it while building a financial model, and neither will you use that while building a financial model. These numbers are more important for the internal finance team of a company, but not necessarily for someone who's analyzing a company from the outside. So always remember that while it is good to have that knowledge, it's not really necessary to have that knowledge. And even if you do not have that knowledge, it in no way impedes your learning of the financial statements. You can do the entire spectrum of transaction posting on a company without knowing debit and credit. and I can vouch for that in terms of the entire exercises. You can make the entire balance sheet, P&L, cash flow, linking to each other, talking to each other without using any term around a journal entry or a ledger entry or a debit or a credit. So it's great to know that, but honestly, it's not needed or it's not expected from an MBA in finance. You will never find a role in that. You'll mostly not get a job in that. There are better people who are available to do that for you. So there's no point breaking your head too much over it. Just keep a simple mathematical identity in your head. Every transaction should result in the balance sheet remaining balanced. If this one concept you can understand in your head, any transaction, either the balance sheet moves on both sides or it rearranges item on one side. So once you have a starting point of a balance sheet, every transaction, the balance sheet should end balanced. That's all that you need to keep in your mind, right? That's broadly it in this particular session. With that, we kind of come to a close to this particular session. Thank you.